What if I told you that the biggest mistake investors make in the stock market has nothing to do with numbers and everything to do with two emotions you feel every single day? It's not about complex charts or secret formulas, it's about human psychology. Before we dive in, please remember that this video is for educational purposes only and is not financial advice. My goal is to help you understand these concepts so you can make your own informed decisions. With that said, in this video we are going to break down the two essential emotions that control the stock market: fear and greed. I will provide a clear framework from the world of behavioral finance that simplifies market psychology, and by the end, you'll have an actionable step to avoid common investment mistakes. Make sure you stay for the final point, where I'll share a timeless piece of wisdom from Warren Buffett that can change your entire approach to investing. Let's start with the more seductive of the two emotions: greed. In the world of investing, greed doesn't always look like a villain in a movie, hoarding gold. More often, it wears the mask of something else: the fear of missing out, or FOMO. Imagine this scenario. A new technology stock is the talk of the town. Your friends are talking about it, the news is covering its meteoric rise, and every time you check, the price is higher than it was yesterday. You might not fully understand what the company does, you haven't read its financial reports, but you see people around you making what looks like easy money. That feeling in your gut, the urgent whisper that says, "Everyone else is getting rich and I'm being left behind," that is the voice of greed. It's a powerful motivator that causes investors to abandon logic and discipline. They throw money at an asset not because of its intrinsic value, but simply because its price is going up. This is the fuel that powers market bubbles. We saw this during the dot-com bubble in the late 1990s. Companies with no profits, sometimes with no real product, were seeing their stock prices soar to unbelievable heights. People were quitting their jobs to day trade. The belief was that the old rules of valuation no longer applied. This was a new paradigm, but it wasn't. It was just mass psychology, a collective wave of greed washing over the market. When the bubble inevitably burst, fortunes were wiped out. More recently, we've seen similar behavior with meme stocks or speculative cryptocurrencies. The story is always the same. A rapidly rising price creates a frenzy. The frenzy attracts more buyers, which pushes the price even higher, creating a feedback loop of pure greed. The problem is, loops built on emotion rather than value are incredibly fragile. And when they break, the other powerful emotion takes control. That emotion is fear. If greed is the intoxicating climb to the top of the roller coaster, fear is the terrifying, stomach-lurching drop. Fear in the market is the instinct for self-preservation dialed up to 11. It's the panic that sets in when red numbers fill the screen and the value of your life savings seems to be evaporating by the minute. Think back to the financial crisis of 2008 or the sharp, sudden market crash in March of 2020. The headlines were apocalyptic. Experts were predicting a new Great Depression. The prevailing mood, the overall market sentiment, was one of absolute terror. In these moments, rational, long-term plans go out the window. An investor who carefully constructed a diversified portfolio for their retirement suddenly feels an overwhelming urge to just stop the bleeding. They sell everything, converting their temporary paper losses into permanent, real-world losses. This is called panic selling. Just as greed creates a feedback loop on the way up, fear creates one on the way down. One person sells out of fear, which pushes prices lower. This scares the next person into selling, pushing prices even lower still. It's a stampede for the exits, and in a stampede, no one stops to think. They just run. The irony is that the moment of maximum fear is often the moment of maximum opportunity. By selling at the bottom, investors are doing the exact opposite of what they should be doing. They are selling their assets at the biggest possible discount, ensuring they miss the eventual recovery. And understanding this cycle is often the key to breaking it. By the way, if you're finding this breakdown of market psychology valuable, and you appreciate this clear, in-depth approach, a quick click of the subscribe button below is the best way to let me know. It helps this channel continue to create helpful content just like this. Now, let's move on to how we can actually measure and use these emotions. So we have these two powerful forces, fear and greed, pushing the market back and forth like a pendulum. On one extreme, you have euphoric greed, and on the other, you have desperate fear. The field of behavioral finance studies exactly this phenomenon, how human psychology impacts financial decisions. It acknowledges that we are not the perfectly rational, calculating machines that traditional economic models assume we are. So how can we get a sense of where the pendulum is at any given time? Investors have actually developed tools to measure market sentiment. One of the most famous is the Fear and Greed Index. It combines several different indicators like stock price momentum, trading volume, and market volatility to generate a single number that estimates whether the current market mood is leaning towards fear or towards greed. When the index shows extreme greed, it's a warning sign. It suggests that investors have become complacent and euphoric, and the market might be overbought and due for a pullback. The risk level is high. Conversely, when the index shows extreme fear, it suggests that investors have panicked and the market might be oversold. This can signal that a buying opportunity is near, as pessimism has reached its peak. The risk of selling is high, but the potential reward for buying is also high. This brings us to the single most important lesson of this entire video, perfectly encapsulated by the legendary investor Warren Buffett. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." Let's break that down. Be fearful when others are greedy. This means when the market is euphoric, when everyone is convinced that stocks can only go up, when the fear and greed index is pegged at extreme greed, that is the time for caution. It's the time to resist FOMO, to stick to your plan, and maybe even trim some of your profits from assets that have become overvalued. It means don't follow the herd into a buying frenzy. The second part is the real key to long-term wealth creation. Be greedy when others are fearful. This means when the market is crashing, when the headlines are terrifying, when everyone is panic selling, and the index is showing extreme fear, that is your moment. It's the time to have courage. If you have a long-term time horizon and cash available, this is when you can buy quality investments at a massive discount. It feels wrong. It feels scary. Every instinct in your body will tell you to run with the herd. But this is how generational wealth is often built, by buying valuable assets when no one else wants them. So we've covered how greed, driven by FOMO, creates market bubbles, and how fear leads to panic selling and market crashes. As you can see, these two powerful forces create a predictable cycle of emotional investing. But the key isn't to eliminate these emotions, it's to recognize them in others and manage them in yourself. Mastering this is the foundation of sound market psychology. To make this practical, here is your one assignment. This week, open a news app or website and look at the financial headlines. Don't look at the numbers. Instead, try to identify the emotion. Are the headlines euphoric, celebrating new all-time highs? That's greed. Are they panicked, warning of an impending crash? That's fear. Just practice labeling the sentiment. I encourage you to share what you find in the comments section below. If this kind of practical, psychological approach to finance is what you find valuable, and you want to continue mastering your own investment decisions by understanding the why behind the market moves, the best way to support this channel and see future content is to subscribe. To do that, just click the subscribe button right below this video and be sure to turn on notifications. Thank you for your time and attention today, and I look forward to seeing you again.